Welcome to Eide Bailey's final of 3 webinars on GASB's Revenue and Expense Recognition Preliminary Views document. We held our first part back in February on chapters 1 to 3 and our second part in March on chapter 4. And if you missed them, there is some availability on our website. We'll do a quick review anyway of the framework just to set the stage for today in a little bit. Comments were due to the GASB on February 26th, but as a reminder, GASB is still accepting your written comments if you want to provide something. Public hearings have been going on since then. And starting next month, the GASB staff are going to begin to digest what they heard and what was responded to. And once digested, the deliberations with the board will last at least another year. We're going to have some time until a final standard may be released by then. Certainly, there is some availability, again, to comment. You know, in terms of the public hearings, there was some give and take. There was also some give and take involved with the financial statement improvements project. And there were certainly some ideas of actually combining, you know, the short-term financial resources measurement focus and basis of accounting from the financial resources, the financial reporting model improvements project into the revenue and expense project. But I'm not sure that that will go forward, obviously. We'll find out over the next few months. You know, earlier this week, the GASB did approve the technical plan, and there was no change in terms of the projected dates for this project. So we're going to go through and do a quick overview of the conceptual framework before we get into anything. Do a little bit back into a deeper dive into the expense recognition side of the equation. We already did the revenue recognition side. Dive a little deeper into categories A and B. We'll then talk about the GASB's preliminary views on measuring transactions. And then finally, the potential impact on governmental funds on this project. Now, again, before we go further, there was that call from many responders to the FRM project to consolidate. Whether or not that goes forward, stay tuned. It could be an interesting next couple of years for sure. So let's take a quick run through the conceptual framework. We talked about this earlier in March, also in February, but we're going to apply this now eventually to the expense side. You know, the true norths were applied to revenue. We're going to then go down the road of applying it to expense, and it's basically the same thing. As I said in my previous webinars, you know, you're going to see this framework over and over. But as one of my fellow deputy controllers used to say, 10 times for the normal mind, 100 times under stress. And we're all under stress, especially as we get towards the end of the month. Here, the first true north is revenues and expenses are of equal importance in the resource flow statements to the GASB. The second piece is the GASB wants to categorize revenues and expenses independently and not in relation to each other, simply because of the different types of expenses that we run into. The third piece is for financial accounting and reporting purposes. The government is a economic entity and is not an agent of the citizenry. It is separate from the citizenry, but of course the citizenry elects the government. The fourth piece is symmetry should be considered to the extent possible in the application of the 3 components of the model. And then finally, the GASB wants to provide a consistent viewpoint from whoever or whatever is providing the resources, and in order to analyze the revenues and expenses model as we go forward. Now, net reporting is different than symmetry. The GASB wants to convey that symmetrical principles should be developed for categorization, recognition, measurement, and the measurement proposals and they want to apply it to both revenues and expenses. Now, this may be different than what we're doing now, especially in the transactions that are the result of estimates. After all, the estimation process of, say, uncollectible property taxes is done differently by every government. And so, what the GASB wants to do is try to harmonize as much as possible and try to make things as symmetrical as possible. And again, the GASB wants to have a form of a consistent viewpoint in recognizing revenues and expenses. Now, if your government is a receiving government for a grant, the recognition of revenue should be the same as other governments receiving that grant. Now, if your government is a paying government for the same grant, then your government's expense recognition should be the same as other governments doing the same thing. And so you'll see that a lot of the principles mirror each other. And I think actually that's a good thing. So now when you apply the true north to the expense side, it again is a mirror image. As we all know, most of the outflows have something to do with some form of compensation, employee benefits, or providing consideration in exchange for goods and services. Now, sure, we have debt service, but so far that model for outflows of debt service is not slated to change, even in the financial reporting model improvements project. And as we also know, most of our outflows have nothing to do with most of our inflows. We have to remember that most of our inflows are general revenue, meaning they're not tied to a specific program or service. Now, yeah, we have business type activities and of course, program revenues that fund services. But in most governments, most dollars flowing in are then budgeted toward many programs then flowing out. And if you think about it, public safety is funded through a variety of sources. For example, let's say you're in a school district. K through 12 is funded primarily through taxation and grants. It'd be very few and far between that a school district charges an individual student, to pay for an individual class. Now, of course, you do that in higher education, but K through 12, different story. Now, due to the setup for the outflow side, expenses, there's going to be very few category B transactions that will be expenses. We learned about categories A and categories B during our last webinar on the revenue side. But so far, only general state aid to other governments and state sales taxes that are shared with other governments are included as part of the cases in preliminary views as category B. Now, could there be more? Sure, but I think the model probably needs to develop a little bit more. Now, like revenues, both categories of expense recognition are based on some form of legally enforceable claim. Now, such claims are based on either the government having to do something in order to recognize the revenue or expense, which is category A, or there is some force of law, regulation, or other compliance aspect which would result in category B. Now, to categorize expense, 4 steps are involved, as they say on the screen. For those of us that are here in the previous sessions, guess what, folks? These are exactly the same as the revenue side, except obviously the opposite transaction. So, of course, step 1, does the government have a decrease in net assets? And step 2, does the decrease in net assets result in a related asset? And we'll get to that in a little bit as to how does it result in a asset, when you decrease the net asset. Step 3, does the decrease in net assets result in an outflow of resources to a future period? And then if all else fails, in step 4, you recognize expense. And for those of us who are still digesting from lunch and you have the after lunch hangover, here on the East Coast, of course, for those who need a visual, here it is. Again, if no decrease in net assets, stop, no expense. It's outside the scope of this project, and it would not result in a transaction. If there's a decrease in net assets, but it also increases an asset, well, guess what? You land up in a transaction, as I introduced a couple of seconds ago. You would increase an asset account, and a good asset account which would increase as a result of a decrease in net assets would be such as a thing like prepaid insurance, and there you debit asset and you credit cash. Or, let's say you have a payable account that you're going to pay your bill later. Obviously, you increase payables. But, at the end of the day, you debit asset and you credit cash. Now, if that's not your transaction, then is the decrease in net assets applicable to a future period? And if the answer is yes, then you have a deferred outflow of resources. And if the answer is no, then your debit is to expense. Now, as I talked about during our last webinar, I know what you're saying. GASB 63 has been out there for over 10 years. There's no such thing as net assets. And again, the GASB staff know this, and they're just setting this up as part of the conceptual framework. And eventually in the final standard, they'll make changes, I certainly hope. And or who knows, maybe we'll go back to net assets and everybody will be fine and dandy. But my guess is that train has left the station. Okay, now that we've reset and we've refocused based on what we learned last month, let's get a little bit deeper into the expense side. And again, GASB so far is not proposing to change much that is already in the conceptual framework. Already we have payables being recognized when there's a present obligation to satisfy resources or sacrifice resources that results in an expense transaction. And we're also back to our binding arrangement requirement we talked in the previous webinars, meaning that there is some terms and conditions we got to deal with. And there is a direct exchange or at least some form of non-exchange transaction. Now, GASB's view is that advances would be declared when resources are provided before a payable arises, which would be an asset. And it doesn't matter if that advance is refundable. It is still an advance and it's a deposit. And therefore, in this case, it's a prepaid asset. It's not an expense as no services have been received. Now, if you're saying to yourself, not too different from today, guess what, folks? You are exactly right. In this case, again, debit prepaid assets such as prepaid insurance or an advance, and credit cash. Now, again, let's apply those to expense recognition. You can almost see it as a timeline on the screen. And should this ever come to a GASB standard or multiple standards, it's almost as if each expense might have to be mapped out as it is here on the screen. But this is easier than the revenue side we talked about last month, where there are multiple potential categories that we have to deal with and multiple potential revenue streams we have to deal with. As we discussed in previous webinars, we're using a performance obligation approach to category A, and in this case, an expense. So if we have a performance obligation, we must receive something to pay something. And category A expenses are then recognized as each performance obligation is satisfied and a payable arises. Cash paid prior to the legally enforceable claim are then assets. And again, we're talking about a prepaid asset as we said a few seconds ago. Now, here's our timeline. Let's put this into a visual. If we pay assets before a legally enforceable claim, again, debit prepaid assets, credit cash. And once we have a payable, the prepaid is credited. But if we are unable to recognize an expense due to the time constraints, for example, in a grant, we would then have a deferred outflow of resources instead of an expense. But once those time constraints are satisfied, we credit the deferred outflow of resources and debit expense. But the only expenses that may have started as deferred outflows are in category B. But you're saying, gee, Eric, isn't this again not much different from today? You're exactly right. You know, the GASB hasn't named any new deferred outflows or resources as part of this project. So we may land up with deferred outflows or resources in things like bond refundings, things like pensions and OPEB, and a few other things, but pretty much not much beyond what we're doing today as part of this project. Of course, we're a little too early to tell. The GASB at this point is really only constructing a framework which doesn't exist today. And as I mentioned last month, the GASB's really been driving a car without wheels for decades. They've been building these conventions of revenues and expenses without really some framework to put the revenues and expenses on. And that's really all they're doing as part of this project. So with that, here, let's talk about something a little bit practical. And this is another polling expense. And here we have a village, with a June 30 fiscal year end. And I'm going to go through this a little bit while you answer this. And they contract with a vendor to purchase radios, say for their public safety. And they're not capitalized per the village's capitalization policy. And the vendor delivers all the radios during June prior to year end, and the company sends the village a bill in July for the full amount of the purchase, which is $27,000, and they have 30 days to pay, and the payment is on August 3rd. So what do you think the trial balance would be as of the end of June 30? A, B, C, or D?
All right, here you go, Eric.
Yeah, those who pick the bottom, they're exactly right. And it's not going to be that much different than it is today at all, at least according to the preliminary views. And I happen to think that's a good thing. We're not going to delve too much different. We're just building the car, even though we've been driving the car for too many decades. And so, yeah, using this fact pattern, pretty easy to go through. Okay, let's go down a little further in the expense model. Our key in category A is whether or not, again, we have some form of performance obligation. And as we mentioned, performance obligations are distinct goods or services. The other party to the contract must do something to get something. And once they do something, the government incurs a liability. So, for example, let's say all of us at Eide Bailly delivers a planning memo for your audit, and that delivery is a milestone in your engagement letter, and maybe there's more than 2 or 3 milestones in your engagement letter, but the planning memo is the first one. Then your government has a payable and an expense, irrespective of when you pay for that phase of the audit. Now, again, you could have multiple milestones. You have the planning memo, maybe you have interim field work being completed, then you have final field work completed, then maybe you have another milestone in the reporting, and then maybe you have another milestone in your single audit. And so you could have multiple milestones, but at each milestone, you would have an expense and a payable. The expense would be recognized for that performance obligation, which is in the engagement letter. And each time that milestone is delivered by Eide Bailly, expense would then be generated. Sure, you may have an engagement that goes over a fiscal year end, and that's all predicated in the contract. And you could have a payable at your fiscal year end, as often you do as part of the audit, and that would all be dictated. Now, think about it in a pay period sense. Now, let's say the fiscal year end falls on a Wednesday, and work was done prior to and including that Wednesday, and a payable was generated. Now, if payroll is run on Friday, you already have a payable and an expense, but the payable is only debited for the amount paid on that Friday. And by the way, the benefits would accrue as along with the accrual of benefits. And so again, not too much different than what we do today. Now, I mentioned a few of these other things. Here, hang on. How come this isn't turning? Come on. There we go. I mentioned a few of these already and in the previous webinar. Now, let's put these things into steps. And again, each column would represent the types of goods or services, and each row is sort of a slice of time. And this is a good way to understand what is going on in performance obligations. In the first column, we're using an employee's pay period, which is what I just talked about, with each period worked, the government declares a payable and an expense based on whatever is in the employment agreement or law, regulation, or contract, collective bargaining agreement, whatever. Since the work cannot be returned, then the government has an expense. And at the end of the pay period, the employee is paid. Now, in the second column, let's go back and engage Eide Bailly for your audit services, and your government agrees to pay monthly based on some form of milestones and further based on those deliverables. As each milestone is met, then we have a payable and an expense just for the milestone. And if a milestone straddles a fiscal year, such as final field work or the single audit or the financial audit, then a payable would straddle the fiscal year. Now, for budgetary accounting, if you use the encumbrance system, which is what I used when I was a preparer, yes, you would still have an encumbrance for the entire contract. But let's stick to what's in the PV. We're just talking about financial reporting and not about budgeting. So when we sign an annual contract, the third column would be, like I said, we're signing an annual contract to clean our building nightly. And the services are for multiple years. And with each cleaning, there's an expense and a payable. Now, let's put this in another context. Let's say a sheriff's vehicle needs a tank of gas. The tank of gas would not meet any of the three columns here. It's just a point of purchase. And that would not be changed by this project. So you swipe the credit card, or you swipe the electronic transfer card, you debit expense, you credit cash if you're using a debit card. So again, not too much different than what we did today and in previous webinars. So we learned about the four-step process of categorization over the past couple of months. So to refresh your mind, let's align it to the cleaning contract I just spoke of. All right, so our first step would be an identification of a binding arrangement, and that's the contract with the cleaning company. It can be presumed to be enforceable by law, and the document has economic substance because it's expected to result in cash outflows for the government to the cleaning company. And step two, do you have some form of mutual assent between the parties? Yeah, both parties, the government and the cleaning company, approve the terms and conditions, and the government could be bound by the terms and conditions in the contract document. The cleaning company approves those terms and is bound by the arrangement. So with each cleaning or each month or whatever the document says, the government pays the cleaning company. The third step would be identification of rights and obligations that are substantive. And the substantive rights and obligations can be identified. Your government receives cleaning services every day or every few days in accordance with the contract, and the company has a right to be paid in order to provide the services for the specified period. And then finally, are those rights and obligations interdependent? Well, the cleaning company has a right to be paid, and it's dependent on them also cleaning your building, as is agreed upon in the contract. And it's the government's obligation to pay the cleaning company as detailed in the contract. And in that case, we do have a category A transaction. But if any piece of that is not in the contract, then we have a category B. So let's go down a little further into category A. Here we have a school district payroll. We have an academic year that is off cycle, like most school districts I know. It's off cycle from the fiscal year. Payments are made during the summer for work performed in the previous academic year, September to May, which means we have a portion that remains payable at year end, and the year end is June 30. That's their fiscal year. So do we have some form of binding arrangement? Yes, we do have an agreement that is in place, and it does have economic substance. We have mutual assent, even if it's under collective bargaining, and there are substantive rights and obligations the teachers have taught in exchange for salary, and the rights and obligations are interdependent. And so we do land up at a category A. Since the payment schedule is through the fiscal year and not the academic year, we have an expense with each pay period. We have a credit to a liability for unpaid amounts at the fiscal year end, and a credit to cash for the amounts paid through June 30. And guess what? That's exactly the same as what we're doing today if your school district pays on an academic year. Pays on a fiscal year instead of an academic year. And so it's just, again, we're building that framework from what we're doing today. One of the things that we introduced last month was on expenditure-driven grants. Again, these are category A transactions now for the expense side as well as the revenue side. The paying grantor government in this case must provide funds in accordance with the terms and conditions of the grant incurring allowable costs. Now, in this case, future compliance is not involved in the recognition process, as once the terms and conditions are adhered to, an allowable cost is generated. Now, GASB continues to believe that once allowable costs have been incurred, then a payable can be declared as there is a signed grant award. And again, this is exactly like today. Okay, that's category A expense. Not too shabby, not too difficult to take, pretty easy to go through. But what about category B? Well, remember at the top of the hour, we introduced that category B is really only providing general aid to governments and the outflow side of shared revenue transactions. And as I detailed during the last webinar, general aid to governments occurs when legislation or some similar law requires providing of resources from one government to other governments to fund a specific activity or a program. And the apportionment is based on some formula and may have some base amount, like, foundational pre-K through 12 education aid. Now, these laws usually provide for the timing of transactions, and in my state, when I was a controller, we did quarterly transfers. We called these cherry sheet transfers because the reason why they were called cherry sheet is that's the color of the paper they used to be printed on. I kid you not. And they were on pink paper so that governments would know that they're coming in. And they were called cherry sheet transfers. Now, usually there's some form of appropriation process attached to the aid, and in many cases, an allotment process as well. Now, the GASB's view for general aid to governments transactions, the providing government should provide a payable or recognize a payable when payments are due if both of the following criteria are met. The first one is the provider, usually a state, has appropriated funds for the providing of those resources, in this case down to say pre-K through 12, and the period applicable to the appropriation has begun. And so let's say the appropriation period is from July 1st of 2021 to June 30, 2022, then it meets that criteria. Now, your government may have passed its budget before June 30 of 2021. Well, that's all well and good and fine, but the period for appropriation has not begun as of yet until you hit that July 1st date. And then the second criteria is the state has determined that it intends to provide the resources to the resource recipients. Now, as we all know in budget, budgeting and appropriation is one thing, actually paying is a different thing. And so, especially in times of economic uncertainty. And so the debits and credits do land up almost exactly the same as today when we're talking about general aid to governments. Now, what happens when a state government reneges? Not that we haven't seen this before, that's for sure. Now, GASB believes that in circumstances where the resource providing government cancels its appropriation and communicates the cancellation to the resource recipients, then the state would continue reporting a payable and an expense if the state expresses its intent to provide the payment at some point in the future. And that could be the current year or it could be in a future year. But if the state cancels its appropriation, once that's communicated to the resource recipients, then we don't have any more payable and we don't have any more expense if the resource provider expresses its intent not to provide the canceled payment in a subsequent period. Now, in the last webinar, I heard from somebody afterwards and they said, well, if that happens, yeah, you may cancel your revenue and you cancel your receivable, but you bring on a court case. And of course, that might certainly happen. It really depends on your law or regulation. And it's the same with the expense side. If you cancel this, chances are somebody's going to get a little bit upset. Now, shared revenue is slightly different. Again, there are two transactions involved. First is usually the imposition of revenue, which is tax. And the most common one that I know of is sales tax or gas tax or transient occupancy tax. And the second piece is the sharing of that revenue between governments. And that's usually from state to local governments, or it could be from a local government or a special district down to a local government. And so these have a bunch of different flavors. The law or regulation creates the situation for the binding arrangement. So there are two potential recognition issues. The first alternative is for shared revenue transactions that are supported through periodic appropriations. And again, we're talking monthly or quarterly. In those cases, the expense would be recognized by the state in this case, following the same proposals as those for general aid to governments we talked about a few minutes ago. And now for continuing appropriations, different story. The state paying the shared revenue would recognize a payable when the underlying transaction that produces the shared revenue has occurred, such as buying a gallon of gas has been purchased. If the state has appropriated funds for the providing of those resources, if they use the appropriation process, and the period applicable to the appropriation has begun, and the state has determined that it intends to provide the resources to the resource recipient. So again, not too much different, but think of the underlying accounting. As you go home today, if you happen to be working outside of your home, and you go home today and you decide to get a gallon of gas, and with each gallon of gas, the meter ticks up, and oh, by the way, there's a sticker on there that says, oh yeah, we charge gas tax, federal and state gas tax. Well, think about the process of that state gas tax with each time the meter clicks up and money goes to the state has to turn around and reappropriate it, say, to your local DPW. And so it is a very, very complex process. But what the GASB is proposing is not different from the way it's done today. So with that, our next polling question: what do you think about the expense model so far in the category A and B model? Yeah, pretty straightforward. That the the thing I really like about the expense model is that it's not very different from today. And I'm kind of liking it. In fact, I'm kind of liking it a little more than the revenue side, but we'll see what happens. We have a few miles to go before we sleep, as we say here in New England. So now that we know the accounting, and that's really all the accounting that we need to know about in this one. Okay, what about measuring those transactions? So as we talked about in previous webinars, revenue would be measured based on the most liquid item. That is the prepayment received, such as cash. Expenses would be the same way. We measure based on when consideration would be paid or an amount that is paid already. Then the revenue and expense would fall into the model of using much of the same techniques we use today. Revenues and expenses could include fixed amounts, variable amounts, changes in values, bartering, and oh yeah, non-monetary exchanges, folks. Yeah, folks, those are transactions. You'd be surprised. I mean, there's a lot of bartering that does go on, and unfortunately, the GAAP that surrounds it is just, it's not the world's greatest. And maybe in the future, you might see some update on it. But as we all know, if it's non-monetary, chances are we think it's immaterial. But who knows? We'll see what happens in future GAAP. Financing by using the effective interest method, as we're learning in the lease implementation. Or even incentives or discounts. On the revenue side, the GASB has a view to carry forward the allowance for uncollectible or doubtful accounts. And after all, we don't want to recognize the full amount of revenue if there's a right of refund or a chance that somebody will not pay us. The time factor could be involved for both revenue and expense. And remember those milestones we talked about earlier in the hour. There could be, revenue and expense recognition at each milestone. And finally, if there are grant transactions, well, we're going to focus on measuring what is an allowable cost. And again, not too much different than today. So, okay, now that we've gone through that piece of the measurement and it's not going to change and the expense is not going to change, so what might change? Well, we're going to head down the road potentially of short-term financial resources measurement focus and accrual basis of accounting as proposed for the governmental funds for the Financial Resources Improvements Project. And, in the financial reporting model improvements webinar we did earlier this year, we mainly focused on the quote unquote balance sheet side of the transaction. And remember, we must hit a P&L account for most transactions. And so this project goes down the P&L side. And so let's take a quick spin through the short-term financial resources, measurement focus and accrual basis of accounting as proposed in the FRM project. But now we're going to talk about outflows and inflows of resources. So again, the GASB is proposing to align to the accrual basis of accounting for governmental funds. And this is very different than what we do today. And it's proposing under an accrual basis of accounting that elements of financial statements arising from short-term transactions and other events are recognized as they occur. And elements of financial statements arising from long-term transactions or other events are recognized when payments are due. And there is a big difference there. For the purposes of recognition in financial statements, presented applying this proposed short-term measurement focus and accrual basis of accounting. Events that are recognized in the financial statements would include transactions that are with other governments or other parties, that are very similar to cash in and cash out, and then some form of other events such as internal events, allocations of inflows and outflows of resources such as due tos, due froms, or transfers. And then external events could result in transactions that could be short-term as well, which would be, say, for example, a change in fair value. And we'll get to short-term versus long-term in a bit, but because of this change in the measurement focus and basis of accounting, the GASB is also proposing to change special revenue funds to special resources funds. And why the board is doing this, well, they wanted to recognize not only the inflows, but the outflows from these funds. Now, before we get really upset about this, this is really just a title change. The really big deal in governmental funds is the change in the measurement focus and basis of accounting. Whether a transaction or other event is short-term or long-term is determined by the period that elapses between the inception of the event or transaction and the conclusion of the transaction or other event. And so that's a fairly big change. Short-term transactions and other events are those for which the period from the inception of the transaction to the conclusion of the transaction is 1 year or less. Long-term transactions and other events are those for which from the period from inception to conclusion is greater than 1 year. And again, inception is when you shake hands. Conclusion is when you pay. And so that time period, that's no longer 60 days. That's no longer, whatever your government thinks it is. But the inception to the conclusion would be, the break point would be 1 year. For most transactions, not a big deal. After all, a permit or a license is already cash in and cash out. That, short-term transaction. Or let's say, somebody works for a pay period. Short-term transaction because that pay period is not longer than 1 year. Long-term, not much different than today. But maybe there'll be a little bit less gaming involved based on this word normally, which is proposed to be excised from GASB standards. The word normally would no longer be used as a basis to judge what is the accrual, the normal pattern of paying your bills and so on. So that's proposed to be going away. Now, long-term debt issued for short-term purposes would still be an exception as it is today. So, okay, now where do you get more information? Well, due to symmetry, the expense side of the cases are not that many, but perhaps ones you may want to review. Again, category A will have most of the action, in the expense side. Category B would be really just this general aid to school districts and sales taxes to school districts. With that, we do have some time for questions. I'm going to go into the chat and okay, let's just see if there's anything here. Okay, when does this go into effect? Excellent question on that. So the current thinking, and again, the GASB just did vote earlier this week on the technical plan, the revised technical plan. And as you know, they revise it every 3 months, every 4 months, 3 times a year. I apologize. And so the current thinking is, assuming things go according to plan, we're probably looking at an exposure draft sometime in either late 2023 or early 2024, which could be a final standard by 2025. Now that Now that standard may change. This could land up in multiple standards. This could land up where the financial reporting model improvements piece on short-term financial resources measurement focus, which is about 8 or 9 paragraphs, gets into this project. So there's a little bit of an unknown as to when this would go into effect, but the current thinking is probably sometime in 2024, 2025 for a final standard. What would be the implementation on that? Your guess is as good as mine. But if we think about when the current revenue and expense model that we mainly use has been put into place, statement 33, which was on non-exchange transactions, and statement 36, which was on an adjustment to non-exchange transactions, those came out right around statement 34. Well, duh. In 1999. And we've been using that model for the better part of well over 20 years now. And so by the time this gets out, it'll be well over a quarter of a century old. Now, those things came out as a cluster. Assuming the financial reporting model improvements project comes out at some point, they're thinking May of next year, assuming it doesn't get delayed by movement of the short-term financial resources measurement focus pieces. Well, could there be some revenue stuff that comes out early? I don't think so. But just so you know, it's probably going to fall pretty quickly behind that. So that's an excellent question. All right, with that, we want to thank you for joining us today. This shows you what the calendar is looking like, but there's a major change to the calendar before we hang up today. June 23rd's session. Instead of talking about other GAAP to consider this year, you asked, and we will provide. We got a lot of feedback for a lot of folks wanting to do a GASB 87 workshop, and we're still formulating what that would be. But the thinking is June 23rd will be the first of probably 3 parts of a GASB 87 workshop where hopefully we'll get really our hands dirty. You may want to pull out maybe a couple of your leases to take a look at, and we'll get our hands dirty on them. We'll try to work through some of those leases live as we go forward. And then coming up in July, I think it's going to be the second week of July. There will be 2 sessions, or actually 1 session the second week of July, and 1 session the final week of July, again, to go through different aspects of leases. So it could be a total of 4.5 to 6 hours talking about implementing GASB 87. We know it's really important for you, and we want to spend a good chunk of time over the next couple of months handling it with you. Next month is going to be GASB 84 and 97. There's still a bunch of governments that are out there that are in the middle of implementing GASB 84. We've gotten a lot of questions on GASB 84, and we think that it's a good idea to share some lessons learned, go through some of the basics, and get you implemented as soon as we can for this June 30th. So with that brings us to a close today. Brian and Amy, why don't you take us home?
Again, thanks everyone for joining, and enjoy the rest of your afternoon.